All right, good afternoon, everyone. My name is Stephen Berard with the investment team at the Foundation for the Carolinas, and this is our quarterly webinar. Um, we have these 4 times a year. We try and do a theme, and this normally my favorite one is the first one of the year because we can talk about everything that happened in 2025, and performance was great, similar to 24 and 23. So we have some great comments to share about that, and maybe a few forward-looking comments on what we're seeing in the first 6 weeks of the year, and kind of if the trends are similar to what we saw last year. Joined by our great partners at Mercer, Travis Pruitt and Tim Westrich. We're also recording this call, so we'll send out some notes after the meeting. And if you have any questions, there should be a chat box, and my colleague Bobby and I are monitoring that, and we can do a little Q&A at the end. But pass it over to Travis to start things off.
Fantastic. Thanks, Stephen. Welcome, everyone. Thanks for those of you that have joined us in the past. Thanks for coming back. And for those of you new, thanks for being here. As Stephen mentioned, we will go through the year of 2025 in a review, and we will do a little bit of forward-looking views from our central teams here. I'll give you a quick update on how the funds are developing just through the first couple of months of the year, because actually the moves have been quite significant in some places. And then we'll go through the standard pool performance for 2025, and certainly be happy to take all the questions you can throw our way. So with that in mind, we'll move forward to the 2025 year in recap. So the first quarter of the year, if we had only ended with the first quarter of the year, it might have been a very different feeling than the one Stephen led with in his comments. There was a fair amount of noise going on in the marketplace. We had the unfortunate devastation of the wildfires in Los Angeles, the DeepSeek release of their AI model, which caused the first crack, if you will, in the veneer of the significant amount of spending that's gone on to support AI model development. And then the early machinations of the new administration did cause some noise and ripples in the marketplace as the administration was focused on governmental costs and on some tariff activity against some of our larger trading partners. And as a result, we got a downturn in the market in the first quarter of the year. That sort of hit its apex with the April 2nd tariff package, and following the pretty immediate pivot by the administration on those tariffs, which were the initial release of which was much, much greater than initially anticipated by most observers, those for them and perhaps those against. The administration pivoted pretty quickly, and from that pivot, basically the market was off to the races. And so you can see as you look at the chart, pretty much up and to the right for the full course of the year, with a slight pause in the fourth quarter, as again participants took a read of the environment, took a finger in the air in terms of the risk profile, and did experience a bit of a correction in some of the AI and some of the more speculative names across the marketplace. But by and large, a really pretty fantastic year across the board for equity asset classes. Bond asset classes, which I didn't include on this chart, also up strongly, which we'll see when we get to the next page. And I joked with Tim when I was putting this chart together that I had put gold on here just to give a sense of what gold had done, and it broke the chart. It was up over 130% for the calendar year. And so since we don't invest in gold, and I'm happy to talk about why if somebody has a question on that, we decided to leave that off. But it was a really pretty good solid year, and it was the third year in a row that we saw really phenomenal equity market returns coming off of the 2022 year that suffered both equity and bond market returns as interest rates went up. There was a lot of expectation throughout this year that we would see a lower rate environment. That lower rate environment led to some focus in the marketplace and narrowness in the marketplace, and we will talk about that more as we move through the next pages. So for those of you that are familiar with our approach, we use this page reasonably often, and so and I'll apologize for the glances away. Something's going on with my machine, so I have to look at a slightly different screen where the presentation is. So if it looks like I'm not paying attention, I promise I am. So really pretty solid return for equities for the quarter, up 2.5%, but really most of the drivers for that were in non-US. And that was really a big portion of the story over the course of the year. You saw on the previous page that non-US equities were up for the full year, well ahead of US large and small cap stocks. Some of that was as a result of weakening of the dollar versus foreign currencies. Certainly, the approach and policies of the current administration has put some pressure on the dollar in the near term. It has been some time since the dollar has experienced any meaningful weakness against a basket of foreign currencies. But we know that those cycles tend to happen. And it's part of the reason why we invest internationally. And it's part of the reason why we invest on an unhedged basis internationally, because we do think part of the diversification benefit is in the currency translation. And we think currencies tend to wash out over longer periods of time. So there will be periods of time where you get an advantage or disadvantage. But over longer cycles, we do think that the currency washes out. And in this case, because we do maintain a meaningful allocation on US, got really nice participation in the quarter from the non-US portfolios. As I mentioned, gold had a really pretty tremendous year, and that was the primary driver of natural resource equities, although we did see in the quarter on at different points of the year other materials related stocks that were related to either semiconductor or electronics manufacturing or energy production. Given the flip side of the coin on AI is the fact that it draws a lot of power. And so the need to build and maintain power plants and the associated kit that goes with those also help to drive certain parts of the marketplace over the course of the year. And we can see that in the natural resource equities. Interestingly, oil didn't have a particularly great year, which tends to be the largest commodity in those spaces. And I mentioned yields did come down in the fourth quarter. We saw the Fed cut rates 3 times this year, or excuse me, last year. That helped to drive 1.1% returns for the quarter. Really pretty solid fixed income results also for the third year in a row. So when we look at the full calendar year, that translated again into really pretty outstanding results. Global equities up a little bit more than 22%, with again those very strong returns from developed international and emerging markets, really helping to push overall portfolios and being quite beneficial to the FFTC portfolios, which we'll see here as we go through. And then a really pretty solid year for bonds as rates came down at the short end and the curve flattened a bit, and the advantage of both the curve flattening a bit as well as the higher coupons that we have now post 2022, helped to generate really a really pretty solid 7% total return out of your core bond position. But there were some factors though in the marketplace that, as there have been for the last couple of years, but they did migrate and adjust a little bit. By and large cap companies were still the primary drivers of overall return. We can see that in the charts here in the circled numbers. Large cap growth leading the way for the full calendar year. Again, those are the companies that you know and love: Microsoft, NVIDIA, Meta. Those types of names are still the kinds of stocks that still drove much of the return collectively, and they are concentrated here primarily in the information technology and communication services. The Alphabet slash Google is in the communication services number, and they had a really pretty solid year as well. So large cap growth for the lion's share of the year was still the primary driver of overall market returns. We did see in the quarter there was a bit. I mentioned there was a pivot in mid-October in the fourth quarter. That did a couple of things. It did show some strength in the more value-oriented positions, right? So that there was some market broadened away from the narrow leadership, and within small and mid, particularly for much of the year, particularly the middle brace of the year, the second and third quarters, low quality or companies with high growth expectations but perhaps negative earnings really drove results to a large extent. And I'll have a chart on that in a minute. But that was key in the evaluation of active management in small mid in the US for 2025. Our managers for FFTC, similar to much of the universe, focus much more on quality, focus on the direction of actual earnings. And this is the kind of environment where that kind of strategy doesn't do as well. And we had a rougher year in the US equity portfolio. I'm happy to announce, though, that it was a really pretty solid participation in the fourth quarter, and it's continued so far this year. So all cycles come to an end, but you can see they can be quite dramatic in short periods of time, as we saw in the middle part of 2025. You can see that here in the last set of numbers I'll highlight on for the full calendar year and for the quarter. we can see that the minimum volatility statistics. So this is a factor in markets that over long periods of time, stocks that generate a lower volatility in general relative to the broader stock market still can present competitive returns relative to stocks, but that certainly comes with a lot of volatility, and it's just helpful to see it here that for the full year, investors were really not terribly concerned about buying low risk stocks. For the basis of the year, they were really focused on those higher risk, higher potential return securities through much of the U.S. market. Just a couple more comments on this. So this chart on the left, this comes from GMO, so thanks to them. But it's just one way to think about, or another way, if you will, to think about the outperformance of higher risk stocks over the course of the year. What this chart shows is the highest quintile of stocks by beta. So those stocks that have the most sensitivity or most relative volatility to the benchmark is the green line over the course of the year. And the blue line is the bottom quintile, the bottom 20% of stocks in terms of beta. So the lowest beta, the lowest risk or lowest implied risk stocks in the markets. And you can see there's a pretty wide spread over the course of the quarter, or excuse me, over the year. During the first quarter, when risk was off, when there was a lot of concern, a lot of volatility, those stocks led on the way down, and they led by a pretty healthy margin. And so had there not been a pivot in April, had there been a different set of circumstances, this is why most investors don't invest heavily in these types of names, because they can have a lot of volatility both up and down, as we saw in the first quarter. But the market did adjust, and we did see investors much more willing to take bets on positions, particularly in small mid, where interest rates and the cost of debt is very meaningful. As investors bet that rates would come down later in the year, it added a lot of fuel to the fire in terms of some of these lower quality and negative earning type stocks. And they performed extraordinarily well coming off their bottom in, call it, early April through basically the end of September, and then with a slight pause in October and bouncing back before the end of the year. Big contribution of those names to the total portfolio. So for the Russell 2500 index, which is the benchmark we use to measure the performance of our active small mid managers, contribution of those highest quintile returns was 6 full percentage points, with only about 1% of return coming from those lowest quintile portfolios. And you can see on the right-hand side of this page that similar to what we have seen in large cap indexes over the last few years, we actually saw that in the small mid as well, with the top 20 names in the Russell 2500 index generating 42% of the index returns. So similar as you might think in a large cap environment, a more concentrated index is more difficult to outperform. And that certainly was the case in the 2500 this year. As I said, that seems to be migrating already. We seem to see an evolution away from that in the market over the last, call it, 5 months. And our expectation is that we will hopefully see that continue. So looking forward, just what are we thinking in terms of the overall environment? We do think global economy is expected to grow, maybe not at a huge pace, but we do expect growth dynamics are in good place, both in the U.S. as well as outside the U.S. We do think U.S. growth can be strong. We'll have some things or risks to look out, as potential contras to that growth expectation. But on the whole, we do think that U.S. growth will be strong. We'll see in a second the potential impact of AI CapEx spending. There are expectations of continued productivity growth. And as we'll see in a minute, there are both monetary and fiscal policy expectations that will help push the bus along as well. So we think overall global economy should be in pretty good shape, with perhaps the U.S. continuing in a leadership position. That does run the risk. A strong economy does run the risk of potentially lighting off inflation again, but we think in general, we expect inflation levels to continue to subside. They are still above the long-term Fed target of 2%, but we're sort of down in the high 2s, low 3s, so we're getting closer. But we do think that we'll generally see those start to recede. The risks to that are any additional changes to tariff policy, or perhaps an interest rate regime that gets ahead of itself and touches off higher demand and potentially higher inflation. I have another chart on this in a minute, but in general, we do think there's room for monetary policy. We think the general direction of the U.S. is probably lower. Our view right now is still is basically in line with the consensus of 2 to 3 cuts in 2026. But I just heard this morning a quick recap on the minutes release, and there's still a fair amount of uh, divergence of opinion in terms of where rates need to go and the importance of inflation by those Fed voters. And so while we would expect to have a new Fed chair by the summer, that path may not change remarkably from where it is today, or maybe even not in the same direction. So we do think that's something to keep in mind. And then, other risks that are on the horizon, certainly, we're in the US, we're largely a consumption-driven marketplace. While consumer spending numbers have held up reasonably well, sentiment numbers haven't been strong. And we'll see a chart on that in a minute. And they came out again this morning, not particularly fantastic. So there is this still K-shaped economy where those at the upper end of the economic spectrum continue to spend, continue to feel comfortable. Those at the bottom end of the economic spectrum are feeling more. They have more concerns. They have more issues with potential, the high costs of things, even if inflation starts to moderate. So there are some risks to that. And as I mentioned, there are some risks that we could overheat to the upside, which would lead potentially to higher levels of inflation. But also, overheating to the upside also probably good for wages and for labor. So some cross currents going on in each of that. So just a few more charts on that. So the U.S. Financial Conditions Index, this is something the Federal Reserve Bank of Chicago puts together. In general, what this chart says is most of the time over the last 25 years, we've been relatively loose in terms of financial conditions. So credit's been available. Equity capital is not terribly expensive. So anytime that number is negative, and so you can see it's about negative 0.5 as of the last reading, that suggests that there's still financial conditions are still relatively loose in the U.S. Investors are able to get the capital that they need to move forward. And capital they are spending. So the combined AI-driven CapEx actually was revised higher more recently. But the numbers that we expect, that the market expects really for 26 and 27 are actually greater than some of the annual spend rates for entire countries, to the tune of, over $600 billion expected for calendar year 2027. So that CapEx, as it has for 2025, helps to drive overall GDP growth. There are still some import components in some of that AI CapEx that perhaps over time, if the administration is successful in its objectives, bring some of that, more of that manufacturing back on shore. But we expect to see continued spending in this space. But as we've seen more recently with investment returns of the Mag 7 or other AI related organizations, there isn't a growing sort of view that investors will need to see some more actual revenue and potential earnings growth, or at least revenue growth for all this capital that's been put in the ground. So that's something that we should keep an eye on. On the positive side for the economy in general, though, is that the tax and spending bill passed last year. The apex of its positive fiscal stimulus will come in 2026, with still decent amount of stimulus in 27 and 28. So from a fiscal spending perspective or a fiscal impact perspective, should be some good things on the horizon, based on current policy and the implementation of that bill. Of that act now that's been signed into law. So this is part of the driver of what we think will help drive U.S. growth, is there should be still good fiscal stimulus from lower taxes, from regulatory changes and the like. When we look at other things that might, again, push back on that, I think non-farm payrolls, which is the chart here on the left, there's the slope of this chart suggests something, bigger picture demographically going on. So I think that bears watching out, because in simple terms, if we have people times what people spend, we get GDP in very, very loose terms. And the fewer people we have spending, the less in GDP we have. So that's something I think to keep an eye on. Certainly these numbers are impacted by the changes in immigration policy. And so I think that bears out, just as a risk that we have to watch and manage and understand what it could have impact on in terms of growth in the U.S. economy. I mentioned consumer sentiment. Consumer sentiment is challenged. Again, primarily at the lower end, the bottom half of the socioeconomic pyramid, where those folks are more stretched. They're more challenged by the cost of groceries and perhaps the cost of gasoline. And so their views on the overall economy and their place in it are a bit more challenged, and we can see that in the consumer sentiment numbers. So, there's a cross current of items, but at the big picture level, we do think that overall there still is the opportunity for growth and potential for growth, and perhaps maybe even see some wage growth at some point if we see the labor market rebound. And then I mentioned I had one last slide here on the economic environment. And as we can see, as is implied by the chart, there's a mix of expectations in terms of directionality for interest rates, with the Fed and the Bank of England expected to come down in rates, with the European Central Bank and the People's Bank of China expected to stay neutral, and the Bank of Japan actually expecting to hike rates. It's been a while since we've had non-coordinated central bank activity, and so in some ways that brings the negative of a potential of overall volatility around the globe as central banks are going in different directions. On the other hand, volatility brings opportunity for active investors, and we have a fair amount of active investment in many of your donor options, and so we think that can be a positive when it comes to seeking excess returns. So I think lots to watch in the economic environment, a lot to keep our eyes on. The known unknowns and the unknown unknowns, to harken back to Secretary Rumsfeld, continue, I think, to be important. And of course, we would highly expect to see some volatility as this is an election year. And as we get closer to November in the midterms, we could see some real impacts as investors start to bet. So I'm sure there's a bunch of other cross currents that we could have talked about, and I'd be happy to take some of those questions on as we wrap up. Sorry, I forgot I have one more slide. So my apologies. I did want to touch briefly, for those of you in the diversified long-term growth portfolio, or if you're just interested, I do want to give you a quick update on the state of the private equity markets. Private markets have got a fair amount of attention. We talked about it was 3 solid years of public market returns, perhaps above trend, if you will, following a pretty difficult 2022. And so that raises headlines. It does raise questions for investors, and I think they're fair. At the same time, you see a lot of headlines in the press about large investors that are large private markets investors, perhaps changing their views or changing their portfolios around private equity. And that may raise some questions, and I think those are fair as well. Certainly with the large investors, and particularly the large investors that you hear about and know, they invest 50 or 60% of their long-term portfolios in private capital. And that's a different address on the risk scale versus where the diversified long-term growth portfolios, which is 25%. So when dynamics in the market start to hit like they have, if you have that much capital committed to an illiquid capital class, then yeah, you have to start to make some changes and evaluate some adjustments in your portfolio strategy so you can meet your liquidity needs. So far, fortunately, FFTC's not in that position, and as we advised to your investment committee last time we did a strategic asset allocation review, we think the maximum of 25% is a right number. No more. We think that's the appropriate number given your unique set of circumstances. So those notions have been impacted largely by a slowdown in the exit market. So this is the opportunity for private equity managers to take companies that they purchased, to do what they're going to do to add value to them, whether that's clean up their balance sheet or that's to merge them with some other companies to make them a more valuable platform. Whatever the avenue the private equity managers are after, they need to then bring those companies back to market to be sold. One way to do that is in the IPO market. So that's the chart that you see right now. And you can see that after a really robust 2021 period, where there are a lot of transactions both in the IPO market as well as in the intercene within the private equity markets, you can see that as interest rates started to go up, the interest rate environment started to change. We saw the IPO market change quite significantly, and deal volume for IPOs shrunk pretty significantly for the next 3 years. We have seen a pickup in IPO activity. You can see it at the back half of this chart. And And that's positive news. We also hear uh, much discussion that you could see some very large private companies like SpaceX and OpenAI come public this year. And if those happen, that could uh, hopefully, shake loose the IPO market and get some additional IPO activity coming. There is some built up, some pent up demand to bring companies to market, whether to sell them on to another larger acquirer or to bring them public. But certainly some bigger, splashier type deals like SpaceX and or OpenAI could really change for the positive the IPO market. So we're watching that. We also have seen in the just the private markets for acquisitions by larger companies of some of these smaller companies. Most of the pickup there in that part of the marketplace has been at the larger end. The smaller end of the marketplace, the small middle market type companies, much less activity going on in realizations at that end of the market. That also, those types of managers tend to be pretty prevalent in some of these larger investor portfolios that you'll read about in the paper. And so they have not got the same level of exit activity increase as we've seen in some of the larger parts of the deal. So fortunately, in your portfolios, we have a range of large and small investments. And so you've had some participation in some of that more recent exit activity. But by and large, we still feel really pretty comfortable about private equity as a class and private markets as a class. But it's a good reminder as we think about the last 3 years that all asset classes go through periodic cycles. Sometimes an asset class will really dominate all others, and then the market corrects and that leadership changes. So we would expect future cycles to look much the same way. But currently, private equity's trailed just a bit. Certainly, in your diversified long-term growth portfolio, as we'll see here in a second, your longer-term performance has been well participated, but the public market portfolios have done just a little bit better. So let's look at the performance at the end of the year. Overall portfolio returns for the quarter were positive. Again, the portfolios are well positioned across the different risk profiles to participate when the market moves meaningfully, and certainly the markets did do so both in the quarter and for the full year. So you can see everything from cash in the liquid reserves, the low duration fixed income, and the income and growth, which is 60% fixed income, all posting really pretty solid returns for the quarter and strong returns for the full calendar year. Portfolio that is 40% equity, still generating a 13% return, is a really nice thing to take home. So that's the lower risk portfolios have performed nicely. When we look at the longer term portfolios from each of these basically have the same core long-term return seeking assets versus risk seeking assets allocation. We can see that the passive long-term growth, which captures the purest expression of that, was up about 2.9%. Active long-term growth right in the same ballpark, and the ESG long-term growth also in the same ballpark. So those three options, as you'll recall, are all public investments. And when we compare that diversified long-term growth also participated nicely in the quarter, but just a bit behind given its less public market exposure. And then when we look at the full calendar year, to Stephen's earlier point, these are really outstanding, strong absolute returns, and you can see on the back of 2 prior calendar years of strong absolute returns across the long-term portfolios, with basically passive, active, and ESG generating very similar results over the 12-month period ending December 31st, and DLTG generating a still strong 15.5% absolute return over the course of the marketplace. So right around benchmark. So we continue to look at the portfolios to see if we need to make adjustments to drive better excess returns. We're in years where active been challenged to be able to deliver about benchmark results. We will take that. And as I mentioned, we are seeing much better results in the last 5 months. Out of the gate here so far in 2026, U.S. large cap stocks are basically flat. They're only up modestly. Small and mid cap stocks are up quite a bit. Non-U.S. developed markets are up quite a bit. Emerging markets are up kind of scary good. They're up double digits already year to date. So don't be surprised if some of that is given back as we go through the course of the year. That's a lot to be up in a 6-week period. So just something to keep in mind. But where the markets are off to a really pretty solid start again so far here in 2026, and with hopefully an environment that leads to an opportunity for better both absolute as well as relative returns. So that is the end of my prepared remarks, and I will pause there and Stephen see if we have any questions.
Cool. Awesome, Travis. Thank you so much. I'll kick us off with one. Lights just went off in our building. But oh, they're back on. When you think about, the last 3 years, right, on paper, really strong, positive performance in all three. But I think what was different last year, what we really benefited in our strategies was twofold. I think one, our global asset allocation, right, like the international and emerging markets, and then also active management within those two asset classes. I think we've kind of been fighting the S&P 500, in 23 and 24, and that kind of changed last year. My favorite anecdote I've been sharing in donor meetings is, our two public long-term strategies, active and passive, actually beat the S&P 500 last year with 25% in fixed income. So we kind of saw a shift there. Maybe talk about, our global asset allocation, then a nugget or two in active management. I know within, quality within small and mid cap, it hasn't been as strong, but there are, within fixed income and international and emerging, active management has been super helpful, especially
Abs
last.
Absolutely. And I hadn't picked up on that. So I love that. I'm going to start using that as well. So thanks, Stephen. I think that's a great analogy. Yeah, I think that's right. I mean, it is part of the reason oftentimes we get asked, how do we manage risk for client portfolios? And risk is not just protecting against losing money, which is an important risk management, but risk is also largely how do we deliver the most consistent results to be able to meet your philanthropic objectives over time. And certainly there's always something that we could invest in that will perform better. And that's certainly been the S&P for 23 and 24, most definitely, that if we'd have just put all our money in that, we'd have been super happy. But to your point, as the market evolves and rotates, the opportunities tend to move around, and they can move around quickly and they can move around violently. And so it can be very hard to get ahead of that if you want to try and be tactical. And in fact, most people can't, professional or amateur, when it comes to investment management. And so one of our best ways to protect against or to maybe raise the probability of delivering more consistent returns is to invest globally. There's a lot of companies, there's a lot of market cap, there's a lot of business outside of the US. And we want to have exposure to that. We do, from a risk management standpoint, we tend to build our equity allocations so that they are roughly in line with the global market cap. And so today, that's give or take a percent or two. The US is about 60% of the global market cap. Emerging markets are, call it, 10-ish, and developed markets are the rest. And so from a risk management standpoint, we think of the global equity market as home base, and we tend to manage around that risk profile. But that gives us basically 40% of our portfolio exposed to companies that aren't based in the US, that oftentimes and that generate their revenues around the world. Those markets also tend to provide periodic opportunities for really stellar outperformance, particularly in developed markets. And so our best performing strategy on a sort of absolute basis, as well as alongside two other strategies, has been the non-US equity LLC, the underlying strategy there. We are looking at some potential changes to that fund for the first time since inception here over the coming months. But it's performed really pretty well through a combination of great fundamental managers and then a quantitative manager that overlays, that's able to be dynamic and move around as the market moves around. We find that exposure has really generated outstanding long-term absolute returns and outstanding relative returns. It outperformed last year. It's really only had about an 18-month period since we began working together where it's underperformed its benchmark. So we've been really pretty happy with that. Emerging markets also was a solid year, actually, of outperformance in a year where you might not necessarily think that it would be available. Emerging markets, active managers tend to underperform when emerging markets post very strong absolute returns. But the combination of our two active managers and our passive core in the Emerging Markets LLC really got the job done. Both managers delivered strong returns for the full year, led by 91, and it continues, we think, to be well positioned in this balance of return seeking versus sort of relative risk to the emerging markets index. We're also looking at a couple of things there a little bit less far down the road in terms of adjustments, but we continue to look at that to make sure that we have the right balance. And then I think to your point, core fixed income has been, the numbers are not huge, so they're on an absolute basis, so it's easy to miss them. But the core fixed income and the low duration fixed income managers have both consistently added value over the course of the last 7 or 8 years. And for those of you in the diversified long-term growth, the hedge fund portfolios have performed really pretty well. A little bit of trail this year, underperformance in 2025, which we might expect in the strongest equity up years. But over 3, 5, and 10 years, not quite 10 years yet, but 3, 5, and longer periods, that strategy has performed well, not only versus the hedge fund universe, but importantly against the fixed income universe, which is what we own it in lieu of. We tend to own hedge funds instead of owning additional fixed income when we have the opportunity to do so. So really pretty nice combination of outperformance in those places.
Great color, Travis. I feel like active management gets a lot of hate these days. If I can call it out and get an opportunity to say something nice about it. But yeah, there's no other questions in the chat. As you can see on the screen, phone numbers and emails. If anything comes up, please reach out. And thank you everyone for joining. And we'll send a follow-up with the recording. Thanks, Travis.
Thanks. Fantastic. Thanks, Stephen.
Have a
Thanks,
great day,
everyone.
everyone.
Thanks, guys.
Take care.